You did it. You actually did it. You built your emergency fund, you torched the credit card debt, you grabbed every dollar of that employer match, you maxed out your IRA, your HSA, and your 401k. You followed the sequence. You did the boring stuff first, exactly like everyone told you to. And now you're sitting there, staring at your brokerage account, thinking, okay, what the heck do I do now? My name is Billy, and the thing that keeps me up at night isn't whether people know how to start investing. There's actually a lot of great content out there covering the basics. What keeps me up is the giant, gaping, terrifying silence about what comes next. Because here's the brutal truth that nobody talks about. The sequence gets you to the starting line. What you do after the sequence is what actually determines whether you retire comfortably or whether you retire rich. And most people, even the ones who did everything right, walk up to that starting line and then completely fall apart. If you want to understand the second half of the wealth-building playbook that most financial content just ignores entirely, subscribe right now and hit the thumbs up, because I promise you, this video is going to cover ground that you have genuinely never seen before. Here's where we need to start, and I'm going to say something that might sound a little harsh. Most financial advice stops right at the moment it gets interesting. You've heard 1,000 versions of the same ladder. Emergency fund, kill the debt, get the match, max the IRA, fund the HSA, cap the 401k, then dump the rest into a taxable brokerage. That's correct. That framework is solid. But that framework describes the plumbing of wealth building. It doesn't describe the architecture. Think of it this way. If someone told you how to build a house and their instructions were just pour the foundation, frame the walls, put the roof on, technically they're not wrong, but they've left out everything that makes the house worth living in. The insulation, the layout, the systems that make it efficient, the choices that make it durable across decades. That's where we are today. The plumbing is done. Now let's talk about the architecture. The single most important financial decision you will make after maxing out your tax-advantaged accounts is your asset allocation. And I'm not going to give you the generic stocks for growth, bonds for stability lecture, because honestly, if you've already done the full investment sequence, you're beyond that. What I want to talk about is something called account location, and it is one of the most powerful and most ignored tax optimization strategies available to everyday investors. Here's the core idea. You now have money sitting in 3 different types of accounts: a tax-deferred account, like a traditional 401k or IRA, a tax-free account, like a Roth IRA, and a taxable brokerage account. Most people treat all 3 accounts the same. They pick an asset allocation, say 80% stocks, 20% bonds, and they just mirror that split across every single account they own. That is leaving money on the table, significant money. The smarter approach is to think about which assets belong in which type of account based on how they generate returns and how those returns get taxed. Here's the framework. Assets that generate a lot of taxable income, things like bonds, real estate investment REITs, dividend-heavy funds, those belong in your tax-deferred or tax-free accounts. Why? Because every time a bond pays interest or a REIT distributes income in a taxable account, you owe taxes that year, even if you didn't sell anything. You didn't make a decision, the fund made a decision, and the IRS sent you a bill. By contrast, assets that grow primarily through price appreciation and don't kick off a lot of taxable income along the way, like broad stock index funds, those are actually more tolerable in a taxable account. When you hold a total stock market index fund in your brokerage, you control when you sell. You control when the gain is realized. You can hold for decades and let that money compound without triggering taxes until you decide to trigger them. This one strategic shift, putting your high-income generating assets in tax-sheltered accounts and your growth-oriented equity holdings in taxable accounts, can add up to hundreds of thousands of dollars in additional wealth over a 30-year investing horizon, not because you changed what you invest in, but because you changed where you hold it. Now let's talk about something that happens every single year in the market, and most investors watch it go by without doing anything about it. Markets are volatile. Even in years where the overall market goes up, there are almost always individual funds, sectors, or asset classes that have periods of decline. And when your investments drop below what you paid for them, even temporarily, that's not just a paper loss that you should ignore and wait out. That's actually an asset. Tax loss harvesting is the strategy of selling investments that have declined in value to realize the loss on paper and then immediately reinvesting the proceeds in a similar but not identical investment. You stay invested, your portfolio exposure barely changes, but now you have a realized capital loss sitting on your return. If you have $7,500 in gains elsewhere, they're now completely offset. If you don't, you just reduced your taxable income by $3,000 this year with $4,500 to carry forward. The one rule you absolutely cannot violate here is the wash sale rule. You cannot buy back the substantially identical investment within 30 days before or after the sale, or the IRS disallows the loss entirely. This is why you reinvest immediately in something similar but not identical, a different fund tracking a different but correlated index, for example. Done consistently over decades, tax loss harvesting adds meaningful percentage points to your after-tax returns, not because you earned more, because you kept more of what you already earned. If you're a high earner, you've probably run into this problem. You went to max out your Roth IRA and then you discovered the income limits. For 2025, if you're single and your modified adjusted gross income exceeds $161,000, your ability to contribute to a Roth IRA starts phasing out. Above $176,000, you can't contribute at all. If you're married filing jointly, those thresholds are $240,000 and $255,000. And so most high earners just shrug, open a traditional IRA or skip it entirely, and assume the Roth is permanently off limits for them. But here's the thing, there is a completely legal, IRS-approved workaround called the Backdoor Roth conversion. And if you're not using it, you are leaving one of the best retirement tools in existence locked behind a door you don't realize you can open. Here's how it works. There are no income limits on making a non-deductible traditional IRA contribution. Anyone can do it. So you contribute to a traditional IRA, $7,000 for 2025, without taking a tax deduction. That money goes in as after-tax dollars. Then, shortly after contributing, you convert that traditional IRA to a Roth IRA. Since you already paid tax on the money and it hasn't had time to grow meaningfully, the conversion triggers little to no additional tax. You now have $7,000 sitting in a Roth IRA growing completely tax-free, despite the fact that you weren't eligible for a Roth contribution. Every year, same move. Contribute, convert. Contribute, convert. Now, there is a wrinkle here called the pro rata rule, and this is where a lot of people get tripped up. If you have other money sitting in a traditional IRA that was contributed pre-tax, the IRS doesn't let you cherry pick which dollars you're converting. They look at your total traditional IRA balance and calculate what percentage of it is pre-tax versus post-tax, and then tax your conversion accordingly. This can completely undermine the strategy if you have a large traditional IRA sitting around. The solution that many high earners use is to roll their traditional IRA into their employer's 401k plan before executing the backdoor Roth. Many 401k plans accept incoming rollovers. If you can move the pre-tax IRA money into the 401k, your traditional IRA balance goes to zero, and then the backdoor conversion works cleanly. It's a multi-step maneuver, but the long-term payoff? Decades of tax-free Roth growth that you technically weren't supposed to be able to access is enormous. Everything we've talked about so far assumes a fixed income. You earn X, you optimize how you invest X, and over time, X grows into Y. But there is another lever that dwarfs all of these strategies, and almost no financial content talks about it because it's not really about investing in the traditional sense. It's about investing in yourself, specifically in your earning power. Economists call this human capital. It's the present value of all the future income you're capable of generating. And here's the staggering reality. For most people under 40, their human capital is their single largest asset by a lot. Your 401k might have $80,000 in it. Your human capital, the total income you'll generate over the rest of your career, might be $3 million or $4 million or more. And yet people agonize over whether to put money in a Roth versus traditional while completely ignoring the fact that a strategic career investment could increase your income by 30% and utterly dwarf every tax optimization they'll ever make. Every dollar you invest in developing a high-demand skill, every strategic career move you make toward higher compensation work, every professional certification or credential that opens a new tier of opportunity, these have some of the highest expected returns available to any investor. And the returns compound in a way that financial assets can't match because your increased income then fuels larger contributions to every account in the sequence we've been discussing. A person who earns $60,000 a year and invests perfectly will build a comfortable retirement. A person who earns $120,000 a year and invests adequately will likely build a much larger one, even with less financial optimization, simply because the raw input is so much larger. I'm not saying financial optimization doesn't matter. It absolutely does, and every strategy we've covered today adds real dollars to your outcome. But if you've maximized all your accounts and you're looking for the next lever to pull, sometimes the most powerful move isn't a new investment strategy, it's a raise, a promotion, a career pivot, or a business development that doubles your income and lets you fund 2 or 3 times of everything else. There's a final chapter to this whole story that almost nobody in personal finance talks about until it's almost too late, and that's what happens to your wealth if something goes wrong. You followed the entire framework. You've got an emergency fund, no high-interest debt, fully funded tax-advantaged accounts, and a growing taxable portfolio. And then something happens. A lawsuit, a disability, a catastrophic illness, a divorce, an estate dispute that rips your family apart after you're gone. None of those events care about how carefully you followed the investment sequence. There are 4 protective steps that belong at this stage of your financial life, and they are the most ignored steps in all of personal finance. First, adequate insurance. This means term life insurance if you have dependents who rely on your income. It means long-term disability insurance because statistically you're far more likely to become disabled during your working years than you are to die. It means an umbrella liability policy if you have meaningful assets because your standard auto and homeowners insurance has liability limits that can be blown through quickly in a serious accident. Second, a will and beneficiary designations. You know what's absolutely heartbreaking? People who spend years meticulously following every financial best practice, and then they die without a will. Or they have a will, but they forgot to update their IRA and 401k beneficiary designations after a divorce, so their ex-spouse inherits everything regardless of what the will says. Beneficiary designations on retirement accounts override your will. That's the law. Make sure they reflect your actual wishes. Third, a power of attorney and healthcare directive. If you become incapacitated and you don't have these documents in place, your family may have to go to court to get the legal authority to manage your affairs. That process is expensive, slow, and public. A financial power of attorney and healthcare directive cost you a few $100s to set up and can save your family enormous amounts of time, money, and pain. Fourth, asset protection strategies if your net worth justifies them. This gets into territory that requires a real attorney, but the basic idea is that certain legal structures, like LLCs for investment properties, trusts for estate planning, can put a legal wall between your assets and potential creditors or lawsuits. Most people never need this, but if you're building substantial wealth, it becomes more relevant over time. Here's the big picture view of everything we covered today. The investment sequence that you've probably already heard about: emergency fund, debt elimination, employer match, IRA, HSA, 401k max, taxable investing. That framework is the foundation. It is essential. It will absolutely build you a solid financial life if you follow it, but it is not the ceiling. After the sequence, the next level is asset location, strategically placing your investments in accounts where their tax treatment is most efficient. Then, tax loss harvesting, systematically capturing paper losses as a tax asset while staying fully invested. Then, backdoor Roth conversions, accessing the most powerful retirement vehicle available even when income limits technically shut the door. Then, human capital investment, recognizing that your earning power is probably your largest asset and developing it has compounding returns that can eclipse everything else. And finally, protection, making sure that all the wealth you've carefully built doesn't evaporate because of an event you didn't plan for. That's the architecture. That's what the house actually looks like when the plumbing is done. Most people never get here. Most people get excited about step 3 of the basic sequence and fall off the wagon before they even finish the foundation. But if you're watching this, you're probably not most people. You're the kind of person who wants to understand the whole picture, not just the highlights. That is exactly the mindset that builds generational wealth. If this video gave you something new to think about, subscribe, leave a comment telling me which of these strategies you'd never heard of before, and I'll see you in the next one.